We're looking at an ugly moment for Wall Street's hottest trade, and that is private credit. Joining us now is Bloomberg's Carmen Arroyo to talk through what happened in one particular incident with a company that was associated with Vista Equity Partners. This is Pluralsight. What exactly happened here that threatened some of the investments involved?
Sure. Thank you for having me. So basically what happened is Vista purchased this company in 2021. It was a time where there were a lot of LBOs happening. And they financed the purchase with a direct loan from a club of lenders in private credit. Since then, the company has not performed that well, and recently they had to pay an interest payment on the loan. The company couldn't do it, or didn't want to do it, or basically had to find ways to make up for the interest payment. So what the company did is basically take out certain assets, basically intellectual property, and put it in a restricted subsidiary, weakening the lender's claim to those assets.
Well, the whole thing about private credit was that it's a small group of lenders, the private equity firm, the private credit firms, they know each other, they trust each other. What happened here? Is this showing that that market is probably not as ironclad as they say, as they are in relationships? Is this the issue?
So I think that this has certainly shocked the market. No one expected to see something like this, because it has become liability management exercises are very common in the leveraged loan market, in the public markets. They're not common in direct lending, especially because of what you said, relationships are important, documents are much tighter. So it's certainly an unusual thing to see, but it's still not the same as in the broadly syndicated market. The way this was done was in a restricted subsidiary, so it's still tied to the covenants of the prior loan. And Vista wasn't as aggressive pitting the lenders as in other situations.
So it's interesting because on one hand, this is fairly unique for the private credit market, which of course has changed a lot in the last couple of years. But at the same time, we've seen similar types of situations, this kind of asset stripping that you are talking about before. Where have we seen it? So
the most famous one is the J.Crew one. It was basically a drop down and asset stripping of the intellectual property. And that kind of set a precedent where basically a lot of other firms have kind of followed that in the broadly syndicated market, but that had not happened in private credit yet, or we at least had not seen it. So it is an unprecedented thing.
Do you think as things get rougher out there, we could see behavior start to change in the private credit market, given we're seeing now the private equity sponsors taking more aggressive moves?
We could certainly see something like that, especially because a lot of the LBOs were done at a time where interest rates were not that high. But we still have to acknowledge that the documents in direct loans are much tighter than the BSL ones. So it could happen, and I don't think it's unexpected, but I doubt we're going to see as aggressive moves as in the broadly syndicated market.